friends, I am happy to reach all of you through this YouTube channel to discuss about income tax return and filing of income tax return. I express my sincere thanks to Neeraj and his team for arranging this video. The filing of income tax return and the calculation of income tax is a current subject because the last date for filing of return has been shifted from 31st July 2020 to 31st December 2020. And in the Finance Act of 2020, there are some changes for the calculation of income tax, because for the first time in the history of income tax, two options are given. One option is the system prevailed up to 2020, and in 2021, for the income related to for the financial year 2021, there are some changes, and that is called option number 2. Therefore, the taxpayer is authorized to select one of the options, that is option number 1 or option number 2. Before coming to this calculation of income tax and filing of return, let us see why the tax is recovered by the government. We all are aware that our state is a welfare state. Our country is a welfare country. In olden days, the main function of the government was to protect the country from external aggression and maintaining law and order. Now, most of the countries have been shifted to the welfare state, because now substantial amount of money is being spent by the government for the welfare of the people. That is, by establishing many projects such as infrastructure development and other projects for generation of electricity, etc. And for infrastructure development and for other projects, substantial amount of money is required. So the funds required for the functioning of this welfare affairs and for the protective system like protecting the country from external affairs and maintaining law and order, substantial amount is required by the government. So it is the duty of the people who enjoy the benefits of welfare state is bound to pay substantial amount to the state exchequer. It is the duty of each and every person to contribute for the welfare of the state. Such voluntary contribution is not treated as tax, but compulsory contribution towards the exchequer is called tax. The tax is defined as the compulsory extraction of money by the public authority for the public purpose, and which is enforceable by law. And it is not payment of services rendered by the government. If a person is saying that he is not expected to receive any services from the government, he cannot avoid tax payment. It is compulsory. That is compulsory extraction of money which can be enforced by law. And there are two types of tax. One is direct tax, second is indirect tax. Direct tax is one on which the burden of tax rests with the person who pays the tax. That means the burden of tax cannot be shifted to a third person. The example of direct taxes are one, income tax, second is wealth tax. If a person receives an income, he has to pay the tax, and the burden of tax cannot be shifted to a third person. Similarly, the wealth tax. If a person possesses certain amount of wealth in his name, he has to pay wealth tax, and the burden of wealth tax cannot be shifted to a third person. So such kind of taxes are called direct taxes. The indirect taxes are one which the ultimate burden of tax can be shifted to a third person. Example of indirect tax is sales tax. The sales tax is being given by the trader or businessman to the government, but he can pass on the burden to the consumer. So the sales tax, even though it is paid by the businessman or trader, there are 4 methods of tax collection. One is proportional method, second is progressive method, third is regressive method, fourth is digressive method. Under proportional method, the tax rate will be the same for all the tax earners. For an example, if a person receives an income of rupees 1 lakh, he has to pay tax of 20%. If a person receives an income of 10 lakhs, he is also supposed to pay the rate of 20, at the rate of 20%. That means proportional tax. Similarly, there is a progressive taxation. That means the rate of tax changes according to the increase in income. For example, if a person who receives income of rupees 1 lakh, he is paying a tax of 10%. If his income is up to 5 lakhs, he has to pay income tax at the rate of 20%. Similarly, if the income increases above 5 lakhs, he has to pay an income of 30%. That means the income rate increases according to the increase in income. That is called progressive taxation. And regressive taxation is the tax slab, the tax rate will be higher for lower income group and tax rate will be less for higher income group. That means, for example, if a person receives an income of 1 lakh, he has to pay an income of 30%. And if he receives an income of more than 1 lakh or up to 5 lakhs, he has to pay only 15%. Such reduction in rate is called regressive rate of taxation. Another method is digressive method of income tax. That means even though the rate of tax increases according to the increase, even though the income is increased, but the rate is not progressive to the increase in income. For example, if a person receives an income of 1 lakh, he is paying a rate of 20%, and if the income is above 1 lakh and up to 5 lakhs, he is paying only interest of 15%. Similarly, the rate of tax increases, but it is not according to the increase in the rate of increase in income. That is called digressive method. In India, we are following the progressive method of taxation. That means the tax rate increases according to the increase in income. In India, tax on income other than agriculture income is levied and collected under the Income Tax Act 1961 and the Income Tax Rules 1962 and the Annual Finance Act. So the income tax is calculated on the basis of Income Tax Act and the subsequent changes which are introduced each year are announced in the Annual Finance Act. So the income tax calculation and submission of income tax return are governed by the Income Tax Act and Income Tax Rules and also the Annual Finance Act. Before coming to the details of the income tax, calculation of income tax, let us discuss some terms, that is assessment year and previous year. Assessment year is a period of 12 months commencing from the 1st April to next 31st March, in which the assessment of income is made in relation to the income received on the previous year. That means income is received on a particular year and that year is called previous year, and the tax assessment is being done in the subsequent year, that year is called assessment year. So previous year is defined as the year starting from 1st April to next 31st March, in which the income is derived, income is earned. So previous year and assessment year is very clear in Income Tax Act and Income Tax Rules. We have to understand these two terms very clearly, then only we can follow the instructions pronounced in the Income Tax Act or the instructions given in the Annual Finance Act. Now, let us discuss about the Income Tax Act applicable for the current year, that is for the year, the assessment year 2001-2002. As I mentioned earlier, there is a change for the current year, that is for the year 2001 to 2002. Assessment year 2001 to 2002. First we will discuss about the old system, that is option number 1 applicable for the current year. Income Income is defined under section 2 clause 24 of the Income Tax Act. The provision, the section gives a list of items under income. That means salary, profit and gains, dividend, interest, bonus and provisions and pension. So the Income Tax Act section 224 gives a list of items which includes under income. So let us discuss about income from salary of an individual. That means the inflow of money that a person or a firm receives in a particular year. It is classified under 5 heads. There is 1, salary. 2nd, income from house property. 3rd is profit and gains under business. 3rd is capital gains. And 5th is income from other sources. Let us discuss about each items. The salaries. Salaries are paid by the employer to the employee. The list of items are there. Let us discuss about the calculation of income under salary. The salary means the salary, allowances, perquisites value, bonus or pension. In respect of an employee, he receives salary, he receives very many allowances, he receives perquisites and he receives bonus. A retired person, he receives pension as per the provisions of law. So the calculation of salary is the aggregate of these items, that is salary, allowances and perquisites. Perquisites value is defined as if an employee is given a quarters for his residence, the value of that perquisites is assessed according to law and it is added to the salary. Therefore, the total of salary, allowances and perquisites is called total amount chargeable under salary. The next item is income from house property. If a person owns a property, house property, and it is given on rent, and he receives rent on that property, the total amount under chargeable is the income, the gross rent received or receivable. If the house is occupied by self-occupied, the income is treated as zero. He need not show any income for that house, provided he should stay in that house. Then he can reduce the tax paid to the corporation or municipality for the building, which can be reduced, and the net amount is called net annual value of the house property. And he is eligible for maintenance cost, that is standard deduction of 30% of the net annual value of that house property. So first you calculate the rent receivable or received or receivable and reduce the corporation or municipality tax and arrive the net annual value of the house. From the net annual value of that house, you reduce 30% as standard deduction. Then you can reduce the interest chargeable by the banks or any other financial institution for the housing loan. If he has availed a loan for construction of house, he can reduce the interest paid or payable by the taxpayer to the bank or any financial institution. And that can be the standard deduction is zero in respect of a taxpayer who resides in his property. So if he resides in his property, the net value, the net income of the house property will be lost. That means he is not expected to reduce the standard deduction because the net asset value is zero. But he can reduce the interest on housing loans. The entire interest on housing loans can be reduced from the total income of salary. That is the benefit of income from house property. But as per section 24 of the Income Tax Act, there is a cap for the loss under the house property, that is 2 lakhs. So even if the total amount is above 2 lakhs, the maximum amount that can be deducted under loss under house property is only rupees 2 lakhs. The next item is the income from other sources. A taxpayer may be having some deposits with the bank or fixed deposits with some other organization, society or some other bank, and he is earning some income. Oh, he has to pay tax for the income earned by him under the income from other sources. Under income from other sources, there are two clauses. One is, if he is not a senior citizen, that the income earned on his SB account can be reduced by rupees 10,000. That means if he is receiving interest in his SB accounts, 11,000 rupees, the maximum amount that can be deducted under house property, that other income is rupees 10,000. If he is a senior citizen, he is not eligible for the deduction of SB interest, but he is eligible for a reduction of rupees 50,000 for the interest earned under fixed deposits. If he is earning an interest of rupees 75,000 under various fixed deposits with various banks, he can reduce 50,000, but he cannot reduce any amount under the income from SB accounts. And these are the four heads applicable for individuals, that is salary income, income from house property, income from other sources, and income from business. Income from business is also calculated as per the law. So the aggregate amount is the total amount applicable for income tax purposes. That is the gross total income of that income tax payer. So you have to calculate first the income from salary, calculate income from house property, calculate income from other sources according to law as mentioned above, and the aggregate of these three factors is called the total gross income for the income tax purpose. And as per the Income Tax Act, Chapter 6A of the Income Tax Act provides certain deductions applicable for the income tax purposes. One is standard deduction. Standard deduction of 50,000 is applicable for all taxpayers or pensioners from his total income. So you first calculate the gross total income, reduce 50,000 first as standard deduction for the purpose of income tax. Then there are some other various deductions applicable for income tax payers. One is ATC, ATCC, ATCCD, etc. That is the total amount paid by the taxpayer under life insurance premium. The income tax purposes, he is opening some accounts under post office, that is National Savings Scheme, and he is opening some account with any other bank for fixed deposits under this scheme, and such aggregate amount should be up to a ceiling of rupees 1,50,000. So under ATC or ATCC or ATCCD, he is eligible for a total deduction of rupees 1,50,000 rupees. In addition to this 1,50,000, he is eligible for a deduction of another 50,000 rupees under ATCCD, that is contribution towards National Pension Scheme, that is called NPS scheme. Under NPS scheme, if he is paying total amount of, he is contributing towards NPS total amount of 2 lakhs. First 1,50,000 it is applicable for under ATCC or ATCCC, and the balance amount of 50,000 it is applicable under ATCCD. That means in addition to ATCC of rupees 1,50,000, he is eligible for another 50,000 rupees under ATCCD if he contributes an additional 50,000 towards NPS contribution. And next deduction is 80D. 80D is for the amount paid by the taxpayer towards mediclaim policy. If a mediclaim policy is taken for self, children or spouse, he is eligible for a deduction of rupees 25,000. If he is a senior citizen, the amount can be increased to rupees 50,000. Similarly, a mediclaim policy taken for the benefits of parents, he is eligible for a deduction of rupees 25,000. If the parent is a senior citizen, he is eligible for rupees 50,000. Thus, 80D relates to the mediclaim policy for the self, for spouse or children or parents. The amount is 25,000 in respect of non-senior citizens and rupees 50,000 in respect of senior citizens. And next very important deduction is 80DDB, that is the medical expenditure for certain diseases are reimbursable. It is 40,000 for some items of diseases, that is cancer, AIDS, etc. It is 40,000, and for senior citizens it is 1 lakh rupees. That means a medical expenditure is incurred by the taxpayer in respect of a diseases mentioned in this act, such as cancer, AIDS, etc. He is eligible for a deduction of 40,000 rupees. If he is a senior citizen, the deduction can be up to rupees 1 lakh. Then section 80U relates to the maintenance and medical treatments of physically challenged persons. If the taxpayer is a physically challenged person, the section applicable is 80U, and the total amount which can be deducted is 75,000 in respect of taxpayer, and in respect of severe diseases it is rupees 1,25,000 rupees. Thus the total deductions can be mentioned as 80CCC 1,50,000 rupees, 80CCD for NPS additional 50,000 rupees, and mediclaim policy it is 80D, that is 25,000 for self, and for senior citizens it is 50,000, and mediclaim policy for parents it is 25,000. If the parent is a senior citizen it is 50,000. Similarly, for medical expenditure it is 40,000 for some of the diseases. For senior citizens it is 1 lakh. If he is a physically challenged person it is 75,000. For severe diseases it is 1,25,000. So take the aggregate of all these deductions and reduce from the gross total income arrived earlier. That is the taxable income of the taxpayer. The chapter 6A of the Act provides certain other deductions also. It is 80E, that is for education loan. The interest paid on education loan for self or dependents is can be deducted from the total income. That is, the full amount of interest paid on education loan can be deducted. Similarly, 80GG, rent paid by the taxpayer can be deducted. There are some conditions to deduct the rent paid. If he is staying in a rented house, he is paying rent for the building. So the rent paid by him can be deducted under three heads. That is, if he pays an income over and above the 10% of his total income, or rupees 5,000 per month sum, or 25% of the total income. If the least of these three amount can be deducted, that means the least of the amount which is arrived under rent paid over and above the 10% of his total income, or 5,000 rupees per month, or 25% of his total income. The least of these three amounts can be deducted from his total income. Thus, in addition to the above mentioned deductions, these two deductions, that is the education loan, interest paid on education loans, and the rent paid can be deducted from the gross total income. That is the net taxable income of the taxpayer. After arriving the taxable income, he has to pay tax according to the slab, that is progressive rate of taxation. If he is a non-senior citizen, he is eligible for an exemption of rupees 2,50,000 rupees. For income above rupees 2,50,000, that is 2,50,001 to rupees 5 lakhs, the rate is 5%. If it is above 5 lakhs and 1, and between 5 lakhs and 1 and 10 lakhs, the rate of tax is 20%. If it is above 10 lakhs, the rate of tax is 30%. So he need not pay any tax up to rupees 2,50,000. Between 2,50,001 to 5 lakhs it is 5%, and between 5 lakhs and 1 to 10 lakhs it is 20%, Above 10 lakhs, it is 30%. That is a tax for non-senior citizens. For senior citizens, there is a tax exemption limit of 3 lakhs. That means up to 3 lakhs. If the taxable income is up to 3 lakhs, he need not pay any tax. Above 3 lakhs and 1 to 5 lakhs, it is only 5%. Above 5 lakhs and 1 to 10 lakhs, it is 20%. Above 10 lakhs, it is 30%. That means if a senior citizen who receives income up to 3 lakhs, he need not pay any tax, but up to 10 lakhs, he is in par with the other non-senior citizens. And if he is a super senior citizen, that is, if he is of 80 years of age or more, he has another concession. That means up to 5 lakhs, he need not pay any tax. Above 5 lakhs, up to 10 lakhs, he has to pay tax up to 30%. Above 10 lakhs, it is 30%. The burden of tax is shifted to a third person, that is called consumer.